Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg, and we are heading into the last trading day of the week. Although the activity remained on the lower side, we have the geopolitics still acting up. It's the US Ukraine allies which are now considering a total ban on the exports to the Russia, and this would further be discussed by the G7 nations in the Leaders Summit in Japan this May. Now, talking about Japan, we must also look about or talk about the possible you know direction from the new governor in the Japanese central bank meeting next week, and the market participants continue to speculate on the probable policy actions, even though the Japanese central bank do not wish and have been clear on their stance that they will not be providing any sort of update or information for the market participants to speculate. But what all said and done, the Japanese economy is still having some pressure with the trade deficit widening to record levels. Now, will there be any change in the yield curve control? Well, time shall tell. But JK, what are your thoughts? How things are going to go about in the coming days?
Hey, good morning, Shikhar. As you spoke about Japan, today they also released the CPI of inflation for the month of March. And data shows that the core CPI at 3.8%, which is the highest since 1981. So would they continue to ignore these higher numbers on price pressures? And for how long is the biggest question. But as of now, they are not giving any indications that they are in a mindset to change the policy. But yes, it was another dull day as far as the markets were concerned. Dollar moving in a very tight range, and even equities were not getting much of a impetus. Only trading on some corporate numbers, Tesla numbers being one of the biggest disappointments for the markets. And then, of course, there has been some profit taking in the stocks after the 5 weeks of hard rally. Then even the yields were reacting lower after hitting good resistances 2-year at 3.66 and 10-year at 3.6. They were attracting good buying in the bonds, and we saw them dip down yesterday in reaction of some data that came yesterday. One of them was the housing sector, which showed the existing home sales sliding 2.4%. Compared to last month, which was higher. And then Philly Fed Manufacturing Outlook Survey plummeted to minus 31.3 from minus 23.2, much weaker than what the market has expected. And then we also had the jobless claims for the week rising by 5,000 to 2,45,000. So all these indications that there has been selective slowdown in certain sectors of the economy, and more importantly, market is watching the employment sector, which is showing the weakness now on a more steadier basis. In fact, the Philly Fed, one of the factors on the Philly Fed was also that the prices paid index went to 23.5, which is the lowest since August 2020, which may be a bit of heartening news for the Fed members. So the softer data on the day added to markets growing voices that US recession is ahead and possible rate cuts, although it did not change the expectation of hike in May, which is still above 85% probability. But now, what is getting more noticeable is the increasing jitters about the stalemate on debt ceiling talks. Now, market worries over the debt ceiling lifted the cost of ensuring exposure to the US debt to its highest level in over a decade yesterday. One of the large investment banks, in fact, warned of a non-trivial risk of a technical default on US treasuries, expecting the debate over both ceiling and federal funding bill to run dangerously close to final deadlines. The spread on 5-year credit default swaps has widened to 50 basis points. So this is the cost you pay for insuring yourself against default by the US government on 5-year paper. And on 1 year, it stood at 100 BPs, which is well above 2011 level. So 2011 was the year when the debt ceiling talks went to the wires, and almost on the verge of a default. And then US was downgraded by S&P as well. So we are already reaching those levels. And is also expectation that the X date, I mean when the ceiling will start hitting, is also getting pushed forward. So that's also a lot depends on how the tax collections, which again market is watching very closely. This is something new, US tax collections being watched closely by the market, because if the tax collections are lesser than what is expected, then government could exhaust its ability to pay all of its obligations. So suddenly there is a shift of focus on this, the debt ceiling progress, and that's probably one of the reasons why market is waiting and watching how it progresses. Everything, investors or traders are standing on their hands, so just to see how things progress. Of course, the House Republican leader said there is a plan to raise the borrowing limit to 1.2 trillion, but they want federal spending cut at 3 times of that amount. Then Joe Biden, of course, said the Congress should raise 31.4 trillion debt without limitations. That's exactly the point of contention. In relief for so the Tapat is in relief for oil importing countries. Crude prices hit a 3-week low on Thursday, trading down over 2.5% amid a significant uptick in the gasoline inventories and continued fears of recession countering demand growth. So oil prices have started to retreat from their high hit after OPEC decision to cut output, even as a number of US data points to economic slowdown. Of course, the recent decision of Iraq to restart export of oil from Kurdistan region has also helped to cool off the prices. That's about how the markets are evolving. A fresh focus on the debt ceiling talks, and of course, the central bank's meeting kick off next week with the BOJ meeting on April 27 and 28. On the rupee, of course, we did have a small relief rally for the rupee yesterday, headed by some flows, and the usual suspects not in the market to that extent. So that really led to rupee gaining marginally by about 12 paisa. And in fact, there is no carry which is prompting the traders to back up these flow-related selling by their speculative positions. So it is purely down to flows and what the RBI does. And I think that state of affairs should continue even as we miss any big directional indication from the dollar index as well. Thank you.
Okay, JK, thank you so much. And yes, folks, it was the Japanese CPI which was released sometime back, and the core CPI at 3.8% is quite high, and definitely we will have to see, or we will see some sort of an action by the Japanese central bank, as these levels are quite concerning for the economy as a whole. But on the other hand, there were limited actions from the equity markets, as well as the currency markets chose to move in a narrow range. But it's the selective slowdown which is being observed in various parts of the economy, which would be in consideration for the most of the central banks in the coming days, as we prepare for FOMC, ECB and BOJ meetings in the coming few days. Quite interestingly, what JK pointed out was the CDS prices on the US debt. And folks, it's quite interesting to hear the possibility of default from the US S&P re-rating the bonds and the debt, as well as the CDS prices for 1 year rising higher. What's exactly going on, it is something which the time will tell. But all said and done, oil price retreating has brought in some sort of relief on the inflation front for most of the economies. So that's it for today, folks. We shall come back again on Monday with another round of updates. Thank you so much for listening.